Hi everyone, my name is Vladimir Ofitserov, and in today's video I will be talking about exchange traded funds with enormous phenomenal dividend yield. Is it real or is it just a fantasy? Let's discover together. And actually, I think this topic is highly relevant because of the emergence of these high-yielding income funds just in the most recent year. And I see lots of groups on X, former Twitter, discussing investments in these funds and even allocating the entire portfolios in these funds. Today we will be talking about two major brands, Roundhill Investments and YieldMax. YieldMax actually has a pretty aggressive PR campaign. They even have their own merchandise like caps, cups, t-shirts, and so on. So in this video, I will discuss the most popular high-yielding exchange-traded funds, and I'll tell a little bit about how they are able to generate this enormous income. And we will conclude with advantages and disadvantages of such investments. But first, I have to say that this video is for educational purpose only, and it should not be viewed as an investment advice of any kind. With this being said, let's start. Here are some examples of the tweets that I've been seeing recently. For example, someone asks, give me 4 or 5 YieldMax funds to allocate 100K for income, and I want to make like 50-60K annually. And someone replies, well, here is the potential portfolio, which would yield like about 62%. And someone says, oh, I'll just go all in YieldMax because it has the most stable capital structure. So, well, let's see how they actually work. This is the summary table of these funds. First column is ticker, so how to find them. Second is their description. And third one is an underlying asset class. So how these funds work? They have, as we can see, some exposure to the asset class. For example, MSTY. It is based on MicroStrategy stock. And on top of that, it has some option structure, which allows us to generate some income, generate returns, additional returns to pay out in the form of dividends. And what we see, current dividend yield is about 168%, which is enormous. But we should be careful because it is an indicated dividend yield. It is based on the most recent dividend this fund paid out. Their dividends can actually fluctuate a lot, so it's not really a reliable metric. And an investor cannot rely on the stable cash inflow from these funds because dividends can fluctuate. Expense ratio of these funds and assets under management, actually that's quite impressive because, for example, MSTY was launched in February 2024 and they already have 1.7 billion in assets, which is quite a lot in the very short period of time. And YieldMax is not that very famous ETF brand, for example. So I divided this table in 3 main groups. So first group is YieldMax funds, which are based on individual stocks like MicroStrategy, Coinbase, Nvidia, Tesla, Meta, and so on. Second group is also YieldMax funds, but they are tied to multiple basket of assets. For example, YieldMax is essentially a fund of funds. So they invest in their other funds inside to provide diversification, of some kind of diversification. YieldMax is Magnificent 7, YQQQ is NASDAQ, And the third category is Roundhill funds. They're a little bit different because they utilize 0 days to expiration options. And those options, they actually provide additional potential boost to returns. And I'll talk about that in a little bit. Okay, so we have our funds, and now let's talk about how they actually provide these returns. Here we need to talk a little bit about options in general. So what is an option? Option contract is a contract which provides the right for its buyer to buy or sell some particular asset at defined price sometime later. And on the other side, someone has sold or written that option, and that side has an obligation to buy or sell this asset at some predefined price later on. So it's a contract for two parties. And well, options can be used in hedging, for example. If you are concerned that your asset can go down in value, you can just buy put option and protect your portfolio, for example. Or if you want to make a leverage bet or participate in the upside, but you don't want to carry some potential downside, you could buy call option. So, and these funds, they actually utilize covered call strategy, which is a very nice strategy, and individual investors can also use it. For example, the good case for that strategy would be you have a stock, you have an asset in your portfolio, and you don't expect it to go much higher in price, but at the same time, you don't want to sell it for some reason, because you don't want to you have huge gain you don't want to realize, or it pays you like dividends or something like that. And but at the same time you want to make some additional returns out of it, and you can start selling covered call options against your stock. In this case, you are limiting your upside in case the stock goes much higher, but at the same time you collect premiums on the regular basis, because you can sell options each week, each month, or even each day if it is 0 days to expiration options. And so you collect these premiums, which essentially represents a dividend to you. So this diagram illustrates the payout for a covered call strategy. Here we have potential profits. Here we have a change in price of the asset. Blue line, it represents if you just own a stock, so stock goes up in value, you have more profits. If it goes down in value, you have a loss. And the green line represents covered call strategy. So when the asset goes up in value, you can still participate in the upside till the moment the stock price reaches the strike price of your option contracts. And at that point, your profits cannot go higher. So your profits are limited and becomes flat at that point. And when the stock goes down in value, well, you are also losing value. But because you collected some option premium, your loss can be a little bit mitigated. It can be a little bit less, but still you incur losses. So that's how this strategy works. And now let's see some examples. So here we compare MicroStrategy stock and MSTY income option fund. And yes, just a brief look. If we started investing in the stock or in the fund around February 2024, so by today, we would be better off in the stock, as we can see. And it is important to note that to be able to compare the fund and the stock, we assume that we reinvest all the dividends that MSTY pays out. So each time we receive a dividend, we just buy more MSTY ETF stocks. So this way we could compare like apples and apples because dividends are huge. And even considering all these huge dividends, we would have been better off by just owning the stock itself. Because as we already know that they sell covered calls, so they limit potential upside, and MicroStrategy has experienced like very pronounced uptrend. And also, so we can see when the MicroStrategy stock goes up, the fund MSTY tends to underperform. However, it is also important to know when the MicroStrategy stock goes down, MSTY actually outperforms. So should MicroStrategy be declining, actually MSTY might provide a little bit better returns than MicroStrategy itself. And MicroStrategy, as we know, just made its entire business about buying Bitcoin. So it's a proxy for Bitcoin. But yeah, once again, we see when there is a pronounced uptrend, the income fund tends to underperform. Let's see Coney, which is tied to Coinbase stock. And here we have pretty much the same picture. So while the stock is in the period of flat, just volatility, we see that ETF, Coney ETF, actually is a little bit better than the stock itself. But once pronounced uptrend kicks in, the ETF is underperforming, and at the end the stock is higher than this income generating ETF. Nvidia is even much worse for the ETF because of the pronounced trend in the stock. So there is no period of volatility. And so once again, this strategy is favorable for the market environment when the stock is highly volatile, but it doesn't experience a pronounced market uptrend when it stays like relatively flat. And this way, the strategy can generate considerable income via option premiums. And at the same time, the stock doesn't go up in value, so you are not missing out on some upside and receive a decent return. And here is actually an interesting one. This different brand, this is Roundhill, and they use 0 days to expiration covered call strategy on S&P 500. So we are comparing this to SPY ETF. And we can see that the fund has done better than SPY itself. And there might be, because of the 0 days to expiration, they have like couple advantages. First one is because this 0DT market is dominated by retail investors, and it is like skewed a little bit. So the option prices are higher. So retail investors are overpaying for that. Implied volatility in these options almost 2.5 times larger than in longer dated options. That is based on Bank of America research. And so that is one point. The second point is that because they only sell calls in the beginning of the day and they are expiring at the market close. So they go overnight without any covered call strategy. They're just carrying the underlying asset overnight, so they can still collect overnight returns, so-called night effect. And there is some research showing that night effect is pretty considerable, and almost 80% of the like market performance has been driven by overnight, not during regular trading hours. So this this fund can actually participate in the appreciation of the underlying asset much more than other funds, because they're keeping overnight performance. And also on top of that, they collect premiums from the 0 days to expiration options they sell. So we'll see how it performs moving forward. So same thing with Triple Q and QDT, also 0 days to expiration, Roundhill, and also we see that the blue line is above the red line, meaning they've done better since the launch of this fund than the index itself. And this one is actually pretty interesting because it is YQQQ, and they sell covered put in this ETF because it is based on the SQQQ, which is short Nasdaq. So they're betting that Nasdaq will go down, but they won't collect some premiums along the way and mitigate some of the potential downsides in that fund. And we can see that when the underlying index, which is short Nasdaq in red, is going down here, the ETF itself has done much better because they're collecting premium from selling the puts. Well, obviously, they limit their potential upside if Nasdaq collapses overnight, for example, because they sold the puts and they won't be able to realize all that gains from the index going down. But at the same time, they're not losing their value as fast when the market goes against them, because Nasdaq index has been growing. And yeah, as we can see, in short, has been losing, of course, but the fund has been able to stay like relatively flat. So again, the favorable market environment for this strategy is when the underlying asset stays pretty much flat or declines a little bit. This way they can make returns while protecting their assets, their overall assets. Okay, so let's make some conclusions. Well, on the positive side, these funds can actually provide a regular cash flow, but it is not stable, it cannot be guaranteed, and yeah, it can fluctuate because option premiums, they depend on the volatility in the market and many other things, so they can be much less when the market is stable. And also on the negative side, the dividends that the funds paid out are subject to taxes, and obviously all my considering was before taxes, so I didn't take taxes into the account, and it can be like substantial drag in the performance. And with the dividends, we cannot control when the funds pay them, so we would have to incur this dividend tax and we would have to receive them. Because when we just own the stock, and we can sell it whenever we want, and make those manage those dividends by ourselves. But with income funds, we just receive them. And well, on the positive side, we can all actually participate in the appreciation of the underlying asset. However, it can be limited. But still, it might be a compromise. Collect some premiums and participate in the rising asset prices. And as we saw, these funds can actually potentially outperform in some market environments. Well, Also important to know that there might be some structural risks in these ETFs, because even exposure to the underlying asset class, they do via option structures. So it's not just they're buying a stock and then they sell covered calls or puts. They actually utilize option structures even for their underlying asset class exposure. So there might be some hidden structural risks that we cannot understand. And if underlying asset, for example, experience some huge negative performance overnight, we don't know how these funds would behave. So something to be careful of. Well, I don't recommend anything here. It's just for educational purpose, and I hope it was useful. And so please like and share this video. Thank you.